Hey guys, it's that Dividend guy coming at you with another list video. So today I wanted to highlight a list from the Motley Fool. 3 great income stocks to buy right now. So my channel is all about dividends and really putting every dollar to the best use possible when it comes to dividends. So what a dividend is, in case people don't know, is it is a portion of the profit that the company generates. So you're really just getting, let's say you own Coca-Cola, right? They sell 1.9 million shares of Coca-Cola every single day, right? You get a portion of that profit when you buy a share. They give you 41 cents per share, so they give you 41 cents for every share that you own, which is a portion of their profits. And then the payout ratio is the metric that determines how much of their profits they're actually paying out to shareholders in the form of dividends. So let's say company X pays out 70% of their income and their generated earnings. So you're getting 70% of the company's profits when you are a shareholder of that company. And so the more profit that they pay out, the more profit that you get. But the problem is you don't want the payout ratio to be too high, because then that means that the business is paying out all of its earnings and it's hard for it to grow. So just a little background check there, just so you guys kind of understand what a dividend is. And a good payout ratio that you want to look for is 40 to 60%. Anything lower than that is golden. There's a couple stocks in my portfolio that have pretty low payout ratios, and I've poured a lot of money into them because they have a lot of opportunity for growth, for dividend growth. So 3 income stocks to buy right now. Let's take a look at what companies they say. First off is AT&T. It's certainly a very familiar name and also an impressive dividend payer with a recent yield of a whopping 6.6%. That payout hasn't been growing very briskly. It has increased by about a penny a year for more than a decade now, but if you start with a 6.6 yield, growth isn't that important. It is important that any company you invest in is healthy and growing, though, or at least it has a solid growth potential. AT&T has plenty of potential, but it has some headwinds too. For one thing, it's saddled with lots of debt, and some are suggesting it might do well to suspend, reduce, or eliminate its dividend, which costs more than $14 billion annually, in order to focus its cash on more pressing matters. The company has taken some action on this front, though, by not increasing its payout for more than a year, ending a 36-year history of annual increases. Another albatross for AT&T has been its DirecTV division, which has been losing subscribers for years as consumers have been favoring streaming services. AT&T has trouble unloading it and has recently cut a deal to spin it off into a new company, retaining a 70% ownership position, with private equity firm TPG holding a priority position. Meanwhile, the telecom giant's recent first quarter earnings report was solid, suggesting that the company has much brighter days ahead. It's announced solid wireless fiber and HBO Max subscriber gains with continuing strong cash flows. We continue to excel in growing customer relationships in our market focus areas for mobility, fiber, and HBO Max. So this has been a steady dividend grow for a long time, but it's recently, with the debt that it acquired from the Warner and DirecTV purchases or acquisitions, it hasn't grown. But with a 6.6 yield, you guys are getting a phenomenal dividend producing machine. They have stayed loyal to the dividend payout currently, and honestly, the way I look at it, I'm a current shareholder of AT&T. I would much rather them stop or cut the streak of dividend aristocrat status and focus more on the health of the business, because once it gets to a healthy point where it's growing, say where DirecTV is not a part of the picture anymore and they're focused with HBO Max, that will, in my opinion, give it a lot more growth, and I think people will be a lot more bullish on the company as a whole. The market will be as well, and I think that will reflect in the stock price. And I think as profits continue to grow, as they cut off some of those dinosaur businesses, the dividend will grow at a much more increasing rate. Next, we have Altria. So Altria is a stock that may not be for everyone, but if you'd be happy with a 7.3% dividend yield and don't mind those dollars coming largely from tobacco sales, it gives some consideration. Like AT&T, part of the reason the stock's yield so high is because the shares have been depressed in recent years over worries about the company's future. While there are signs that AT&T may be turning the corner, may still view Altria skeptically, as smoking is less of a growth industry than it used to be in the United States. Altria saw the writing on the wall, though, and has paid a pricely sum for a stake in Juul vaping business. It didn't turn out as planned and has led to some hefty write-downs, but vaping is growing and the investment might end up paying off more than currently expected. Meanwhile, the CEO notes our 10-year vision is responsibly led by the transition of adult smokers to a non-consumable future. Altria's non-consumable irons in the fire include oral tobacco, electronic vaporizers, and heated tobacco systems. It also holds a majority stake in nicotine pouches. Altria's first quarter results have been released in late April 2020, but the company ended its fiscal 2020 year reasonably well, with revenue and earnings up. Another way to boost its stock price is via share buybacks, and it announced a $2 billion buyback plan. Altria may not serve you well for decades, but it looks like it could for at least a few years, during which time it will pay a fat dividend. Just keep an eye on the company and the payout, considering bailing if it seems to head in the wrong direction or starts facing inconsumable changes. One current concern, for example, is the possibility of regulatory restrictions on nicotine levels. But guys, it does pay a fat dividend. The company has talked about the payout ratio being around 80%, which is exactly where the board of directors and management want it to be at. So it's exactly where it wants to be. About the Juul acquisition, it didn't pan out exactly as they thought it would, but they also do have one in Kronos, which is a marijuana producer, and that they have, I think, a 30% stake in, which will be growing as profits do for the company. They also have a 10% stake in Anheuser-Busch, which is the biggest brewer in America. So they have other avenues that they're making money, as well as wine and spirits businesses that they have. So it's not just tobacco. That's their main business, yes, and they also are very diversified within that sector as well. But they know what they're doing. And even though smoking has been on a decline, they found ways to boost up the dividend and the stock price with share buybacks. Honestly, this is one of those, it's kind of a dividend investor's dream, if you ask me. They are, of course, in a declining business, and they, like it said, they read the writing on the wall, and they invested heavily into other avenues, and that's what management needs to do. Take example for AT&T. They bought DirecTV thinking that was going to be a big growth business. I don't know why they did that, because Netflix was already pretty much dominating the space. I don't know why they bought a dinosaur business, but unlike AT&T buying DirecTV, Altria jumped into the marijuana and hemp business, which that is growing. Also, they have nicotine pouches and other avenues that they've tried out that have been profitable. And just because Juul hasn't been as big of a revenue stream doesn't mean that it was a bad investment. They can write down the losses and take that as a tax cut. So even in a bad investment, Altria is still not, in my opinion, they're not as bad about acquisitions as AT&T was with DirecTV. They overpaid for DirecTV, and then they paid for a dying business, so they paid a premium for a dying business. Altria did not do that. Altria saw the growth potential, and then they used that technology and are trying to make something out of it. And with the possibility that, marijuana beverages could be a thing here in the near future. Legalization is being talked about all over the United States. So being in Altria gives you very good exposure to Juul, to vape tobacco products, to the nicotine pouches, which are a huge growth market. Also to marijuana in general. Also marijuana beverages. So in my opinion, Altria is one of the best ways that you can get exposure to marijuana and hemp without having that downside of it going bankrupt. Because yes, Altria does have a 30% stake in Kronos, but that's not their main business. So if Kronos goes under, just like let's say Kronos doesn't have the explosive growth that they thought, they're still fine. They still mainly operate with tobacco, which yes is a decaying industry, but it's not as bad as say Juul or DirecTV. So like if AT&T was 100% on DirecTV, they'd be screwed. But of course they have their telecom business, and they also have Warner. So that's the thing, is if you guys want to get in on marijuana, one of the big things that a lot of people are hesitant about is they don't know which company to pick. They don't know which company is going to be the one to blow up, which I agree. That's why I picked Altria. That's why I personally own it, because I wanted that exposure to that high growth potential without sacrificing a dividend payment. So Altria gives you the best of both worlds because it pays you a fat dividend. It has 50 plus years of dividend growth. The company has said it's exactly where it wants to be, and it's in these high growth industries that if they work out, great. Altria can keep hiking up that dividend, and it can make a nice business, a nice fat check out of those investments. But if they don't, they can write them down as tax cuts, and they won't be as affected because they're not dependent on that business. So Altria and AT&T have a lot of similarities, but honestly, in the way that it's run and how management has run the companies, I like Altria better. And then there's one that I've never actually heard of, Broadmark Realty Capital. So I'm a shareholder in both of the first businesses, being AT&T and Altria, but I've never heard of this one. So let's take a look. Broadmark Realty Capital is a real estate investment trust, which means that they're required to pay at least 90% of their earnings as dividends in exchange for certain tax breaks. More specifically, it's a mortgage REIT or an MREIT focused on lending to the construction industry, especially to builders. Unlike many other lenders which lend out a lot of money they themselves have borrowed, Broadmark plays it more conservatively, avoiding debt of its own. Also, unlike many mortgage lenders, its loans are generally short-term, as builders only need to borrow until they finish building and then sell their properties. It also charges higher interest rates than those associated with regular mortgages, often more than 10%, and its customers pay often, returning for more loans. What kind of dividend yield does Broadmark offer? It pays out monthly instead of more typical quarterly dividend, and it recently yielded a whopping 7.8, while Altria and to a lesser extent IBM are working through some headwinds. Broadmark's business appears more stable, and with a generous payout, give it a closer look if you're interested. These are just three of the many appealing dividend-paying stocks out there. You may want to add shares of one or more to your portfolio or seek other dividend payers that appeal to you more. Just to be sure to consider keeping a portion of your portfolio in dividend-paying stocks for income for now or in retirement. So guys, let me know what you think about these three dividend payers. I personally own a huge stake in AT&T. I have 171 shares, and I also have a very big position in Altria at 151 shares. So those cover about 22% of my portfolio currently, and I'm happy sleeping at night with that nice dividend coming in. AT&T pays 52 cents a share, and Altria pays 86 cents a share. So these are high dividend-paying stocks with long-term growth histories. So let me know what you guys think. Are there better dividend stocks out there? Do you guys have other stocks that you're maybe maybe you like Verizon? Maybe you like British Tobacco. Maybe you like Philip Morris. Let me know. What your favorite dividend stocks are, and if you hold either AT&T or Altria, let me know the position size, because I do like to get a insight on other people's portfolios. But thank you guys so much for watching. Remember to hit the subscribe button, and when you do, hit the bell notification for more updates. Hopefully you guys enjoyed the 3 income stocks to buy right now according to Motley Fool. Take care, guys.